Hello, everybody. It's Ed Yardeni. Today is actually Sunday, July 12th, and it's 10:20 p.m. I'm pre-recording our weekly webinar. Got another commitment on Monday, so apologize, but we're not going to have a Q&A. But I did want to follow up and all the information that's occurred over the past week or so, and even on Sunday, we're seeing there's news related that'll impact the market. In particular, we have a continuation of the war between the U.S. and Iran. We got shooting war going on. The president claims that the strait is open. In that shooting war, apparently the U.S. Military took some heavy duty action against targets in the Strait of Hormuz on the Iranian side to defang them, to reduce their ability to threaten the transit of commercial vessels, including oil-laden ships through the strait. Let me just move this mic over here. Sometimes I forget this mic, but it's a good old Yeti mic, so it picks things up. But anyways, I forgot to mention we had a nice weekend here. Weather's great, but as I'm sure you all know, here in the States, we got another so-called heat dome coming starting on Tuesday and then Wednesday and Thursday. So not looking forward to that. Question is, with regards to what we do for a living, is should we be looking forward to the earnings season coming up here? This week, we're going to have the major banks reporting, and then it just keeps on going for a few weeks until they all report their second quarters. Some of you may have seen the webinar I did last week with Nick Raish of Earnings Scout. And Nick said that the 20 companies that have already reported, everybody thinks that the earnings season only starts with the banks, but it's actually already started with 20 companies reporting. And he says that's usually a pretty good leading indicator for what the rest of the quarter season, the quarterly earnings season will look like. And he says that the earnings story looks pretty solid. Some of that is Micron, of course, but even without Micron, the earnings, the leading indicators for the earnings season look quite good. Here's my concern with regards to the earnings season, and that is, let's call it great expectations. The expectations for earnings are very, very strong, double-digit increases, 20, something in the low 20% year over year is what people are expecting for the second, third, and fourth quarters. When I say people, I mean industry analysts. And it is industry analyst consensus expectations that gets into the market. That's what the market discounts when we do PE times Z. The market's not discounting what I think earnings are going to do, what you think earnings are going to do. They're discounting what analysts think earnings are going to do. And then it's up to investors to decide how much of a multiple they want to pay for those expectations. And as we've seen over the past several months, earnings expectations have been extremely exuberant. And that's because actual earnings were much stronger than expected in the first quarter. And that led to upward revisions in the second, third, and fourth quarters. More traditionally in the past, what happened is as we get up to an earnings reporting season, analysts actually lower their numbers because the companies that aren't going to report very good results get the word out to the analysts. They want to have this thing come out as a shocker just when they report. So they kind of give the analysts a hint that things aren't going to be as good as they were thinking. So they lower their numbers. On the other hand, companies that are going to report blockbuster results probably think the other way around, and that is let's shock the market by how much better we've done than was widely expected, and that'll have a very positive impact on our stock price. And I think that explains why you tend to see more downdrafts in earnings expectations going into earnings seasons. And then lo and behold, when you actually get into the earnings season, more often than not, you get upside surprises for the market. This time around, it's very unlikely we're going to have any upside surprises, given how strong the expectations are for the second quarter. So, what if we don't meet those expectations? Well, the market will probably sell off on that kind of news. What if we just meet exuberant expectations? Well, the market might still sell off to the extent that those expectations have already been discounted in the market. Now, of course, these sell-offs could very well and probably would be buying opportunities. At the same time, they may also lead to more of a rotation in the market away from some of the areas where earnings expectations have been particularly exuberant. I mean, basically S&P 500 growth, and into more value areas where traditionally earnings expectations don't get as hyped up as they do in growth. So we may actually get more rotation as a result of this earnings season. Anyways, I think we're still in a bull market. I don't think whatever results we get are going to suddenly create a bear market. I don't even think they'll create a correction. And as we've seen of late, anytime you do get a pullback in the market, dip buyers do come in. On another front that's relevant to the market, Fed Chair Kevin Warsh is going to be testifying before Congress this week, uh, 2 days in a row, and he will be asked lots of questions, and I won't be surprised if he said, senator or congressman or congresswoman. I'm not going to answer that because we have a task force working on that. He set up 5 task forces to work on various issues of that. He'd like to reform the Fed. It's not clear exactly what he will do, but he clearly wants to have some cover by having appointed these committees. Looks like each committee or task force has 3 people on it, and I think they have to do with data. What should the Fed do about data? What data should they be looking at? Should they be trying to find more uh, real-time data, kind of like we had during COVID? There were a lot of indicators where people were looking at almost on a daily basis. I don't know why those kind of disappeared. Maybe economists figure that reservations at restaurants, once you're in normal times, they're not going to do much. And so we don't really pay much attention to that kind of data. But there's certainly plenty of weekly data that we all pay attention to, and the Fed does. I'm not really convinced that we have a problem with uh, finding new data series. I think what we need to do is improve the quality of the data series that we already have, and particularly in the employment front, and generally speaking, in the consumer front. On the inflation front, there's a task force for that as well. And, you know, Warsh would like the task force to study the impact of AI on productivity and helping to bring inflation down. At the same time, there's a whole new concern now that AI, before it turns out to be disinflationary by boosting productivity, that in the short term, in the here and now, AI is boosting memory chip demand and prices, that it's boosting the demand for construction workers and manufacturing workers. So that might put some upward pressure on wages. And so all of a sudden, we've got a concern that AI might be inflationary. And by the way, the minutes, the FOMC minutes, the June FOMC minutes that came out last week had quite an extensive discussion of AI. And I guess because Warsh isn't giving any forward guidance. There wasn't much discussion about the productivity enhancing aspects of AI in the minutes, but there was a lot of discussion about the inflationary consequences in the short run of AI. So that's something that seems to be uh, quite. There seems to be a growing consensus among Fed officials, and that's because the data is confirming that. We're seeing some of the CPI and PPI indicators that are relevant to inflation are definitely heating up. Meanwhile, the labor market indicators are looking pretty good, quite good. And as a result of that, uh, late the pivot that the FOMC made in June to go from an easing stance to a hawkish stance or tightening stance is totally appropriate. And the only surprise back then was that even Kevin Warsh signed up and joined the consensus and reiterated that the FOMC's main priority right now is, in fact, to provide price stability, to bring price stability. And Warsh, acknowledged clearly up front that the Fed has not hit its 2% inflation target for over 5 years, and he seemed to want to get the markets to believe that he's really going to bring inflation down. So for all his talk about he's not going to provide forward guidance, he gave a lot of forward guidance. The Fed is no longer in a uh, easing stance; it's in a tightening stance. The Fed is more committed than ever to bringing back price stability. And meanwhile, while he maybe wants to see less communications coming out of the Fed, his view is the market should make up their own mind based on data where interest rates should be, and he'd like to use that information as data to drive monetary policy. But the world isn't that simple, of course, and the markets are going to be looking for any signs, any hints uh, of what Fed thinking is going through. And I don't know. It's possible Kevin Warsh will tell all the presidents of the various regional Feds that they shouldn't be talking anymore, making speeches. But I doubt that he'll actually make a ruling like that. I think he'd get too much pushback. And meanwhile, these people like to talk to the press and have their opinions bandied about in the media. So I'm sure we're still going to get plenty of guidance. There'll still be issues about the whether the dot plot is going to exist. I mean, I'm very biased. I'm a Fed watcher, and to the extent that I'm a Fed watcher, the more I have to write about, the better. But I acknowledge I've called them the Federal Open Mouth Committee, obviously implying that I think that they're talking too much. But again, as a Fed watcher, the more they talk, the more I have to write about, and I'm a content provider, and so are they. But if suddenly they clam up, then that could mean that us poor Fed watchers are going to be left to our own devices, and we may just have to do what Warsh wants us to do, just focus on the data uh, and influence the markets as we think is appropriate, and then the Fed will see what the markets are saying and respond accordingly. I mean, personally, I don't really have a problem with the Fed taking its cues from the bond vigilantes. Right now, the bond vigilantes are sort of in a kind of a neutral stance on their own, waiting to see what the Fed does. But I think the bond vigilantes might have pushed yields higher, but for the fact that Kevin Warsh has come across as a hawk after all, as opposed to a dove, which is what it sounded like when he was interviewing for the job. Well, let's look at some charts that are relevant to all this, as we typically do. Um, let's go to the sharing button here, and here we go. Let's start out with Warsh's tasks or to-do list, and again during his press conference. after the June meeting of the FOMC, just about every other question that from the reporters that basically involved forward guidance, he kind of fluffed off and said, we will have a task force for that, and now they actually do, and it will these task force will give their results by the end of the year, which is still a ways off, and gives us some things to talk about until we get the task force reports, and then we'll see how they actually get implemented. Meanwhile, with regards to that AI story, there's evidence that AI is boosting the economy. We know that, boosting employment. So if it's doing that, in terms of the dual mandate, the Fed has to give less concern to the unemployment rate. By the way, when the Fed eased in 2024 and by 100 basis points and last year by 75 basis points, those easy moves were kind of sold as insurance policies to make sure that the labor market doesn't kind of implode. And now that the labor market's actually not imploding and showing some resilience, I know there's some controversy because of the latest payroll employment numbers, but overall, the labor market indicators still look like it's hanging in there pretty well, all things considered. Um, so doesn't that imply that those insurance policies really weren't necessary? And if that's the case, shouldn't be taken then they be taken away? And if the economy is getting a big boost from capital spending, and a lot of that's getting debt financed, and meanwhile personal savings is going down because the baby boomers are retiring and they're not saving, doesn't that mean that the real interest rate, the neutral real interest rate, is actually going up? And if the Fed doesn't acknowledge that, then the Fed will be too easy, too stimulative. And what's wrong with that? Well, it could be a problem to a certain extent for price inflation, consumer price inflation. More more inclined to think it could be a concern for speculative bubbles. So lots of interesting topics to think about that are relevant to what we do for a living. But here you can see this is a choppy uh, job openings for professional and business services, and we're encouraged to see it go up. Let's see if it chops back down, but we're kind of thinking that AI may actually be creating more jobs now than it's taken away. You don't really see it in this chart without a magnifying glass, but this is looking like it's starting to at least stop going down. This is another one. This is Indeed job openings. The share mentioning AI. It's still small at 5.7%, but it's gone up a fair amount. And I guess if we extrapolate this trend, it's going to go potentially a lot higher. So that's an encouraging sign. We want to see more job openings reflect some conversation about it would be nice if you knew how to work with AI. Construction employment is kind of ticking up. It's already at a record high. Maybe there's also a shortage of construction workers, but certainly while we're not seeing the kind of employment we might have seen in residential housing because it's so weak, we're not seeing a big drop like we had in the past when residential took a dive. Instead, we're seeing that it's holding up at a record high, and that's because data centers are accounting for quite a bit of employment. By the way, there's also quite a bit of construction going on of manufacturing facilities generally, not just data centers. Um, this is just another manufacturing employment. The purchasing managers for manufacturing, that employment was below 50 for quite some time. Let's see if now it's going to finally crack above 50. We suspect it very well might. Meanwhile, business applications uh, have been very strong, and our thinking is that could it be that people who are losing jobs in the some of these technology firms that have talked about layoffs and are actually if, reducing their payrolls. Could it be that some of these people are saying, well, they got rid of our entire group. We were making a lot of progress. We work well together. Why don't we start our own firm? And so that it could be a result of AI. There are inflationary consequences of AI, as you can see. PPI electronic components and accessories up 26.9%. CPI computer software and accessories up 14.5. PCD computers and peripherals up 1.3. That's kind of surprising that it hasn't hit the consumer. But Apple just recently announced that they were raising their prices, and maybe we'll see that there. Um, Electricity prices, they're not soaring, but they're up 5.9%. People would rather not see their electricity bills going up. And that's very well maybe data center related. Uh, the idea of the real rate going up, as we've said before, baby boomers are retiring. We can see that in Social Security benefit payments. The number of people has increased significantly. There's fewer foreign workers in the United States because of the uh, stricter immigration laws. So they're not here doing savings. And so the personal savings rate's declining at the same time that we're seeing more debt issuance to finance data centers. And so that implies that the real rate's going higher. Meanwhile, I don't want to get too negative here. I mean, we are, after all, Yardeni Research is the roaring 2020 shop, and it's the place you come to if you want comfort from the perma bears who are constantly trying to keep you out of the market. Um, the productivity numbers are just fine. And maybe some of that is AI. Look, I think a lot of companies spent the past couple of years basically freezing their payrolls while they studied AI and while they dealt with tariffs and while they dealt with stricter immigration laws. Anyways, they froze their payrolls where they did a kind of top to bottom look at their businesses, particularly from the point of view of AI. And I think after doing that, they've concluded that some areas AI could replace workers, other areas AI could very well augment the productivity of workers, and other areas AI had no relevance. And so, anyways, you put it all together, when you kind of go through your company like that, you could very well increase productivity just by going through the exercise of trying to figure out what could use some more efficiencies and what you really don't need. And meanwhile, while the CPI inflation rate, the core PCD inflation rate's going up, as is the CPI, unit labor cost inflation is actually down to 0.5%. Warsh has said he'd like to use a trimmed mean PCED, which is a 2.41%. I don't know where our Elias and I have talked about it, and we wrote about it in the morning briefing. Uh, our preference would be a CPI or a PCED measure that just excludes owners occupied rent. It's a nonsensical concept. It's what would owners have to pay in rent to themselves if they were their own landlords. It's a really cockamamie idea. Uh, and it is above the 2% target, so it is one of the reasons that inflation is higher than 2%. Let me skip through these, they're kind of related. Here you have the consumer prices, less energy, food, and shelter. So this is, if we can't take out OED, owners occupied rent, OER, um, we can still see that core inflation, excluding shelter, is going up. And this is the same thing for the CPI, not going up quite as much for the CPI. This is the housing services uh, in in the PCED, in the consumption deflator. You can see they've come down substantially. Excluding them, we have what is called the core inflation rate. So services, excluding energy and housing, and that's ticked up to 3.9%. So there's still an inflation problem out there, and this week will be a big week, not just for Warsh testifying, but also for the inflation news. It's another super core. This kind of looks at the super core inflation rate as well. Consumer looks great. They're traveling. You can see that even though airfares have gone up, the TSA travelers checkpoint. Again, if the economy is doing well on the consumer side, hanging in there on the employment side, then in the dual mandate, the Fed's job is to focus on price stability. This is U.S. air carrier revenue passenger miles. We've looked at this many times. Every week we look at it. Retail sales are looking just fine. And this chart you all know by now, baby boomers are sitting at a gold, literally a gold mine of net worth, $89.8 trillion, including the silent generation, 19 point. So there's like $100 trillion in net worth amongst basically senior citizens. Let's have another look at the market call. We always like to give you a handle on what's going on with PE times E. Let's focus on E, and this one's called Great Expectations. I just discussed that. And you can see great expectations by analysts for 2027 earnings. 2026 is kind of flattened out. Forward earnings, time-weighted average of these is going up. I mean, if this just kind of hangs in there at 400, then forward earnings will be at 400 by year end. And 400 times, let's say, a PE of 20 is 8,000. We're using 8,000, 2050 because earnings will probably continue to go up for 2027. So we might very well get to 410 by the end of the year. This is the quarterly growth rates. So let's look at the second quarter. That's the earnings season that's starting now. And you can see that the expectations notched down a bit. But we're looking at amazing numbers, 21.6 year over year for the second, 21.6 for the third, and let's see if I can't see it, maybe you can't see it either, 26% on a year over year basis. So expectations are great. Some of those expectations, these are the sectors that we have expectations for the second quarter. And uh, this is 23.7% on a pro forma basis. Technology is a whopper 65.5%, materials 32.6%, energy up 117, and everything else is kind of garden variety, kind of double digits, high single digits, and then the only downer is actually healthcare. So what happens if earnings turn out to be kind of what's expected for technology, or energy is obviously going to float around with what the price of oil's doing. So what happens if we get we meet expectations here in technology? Will that lead to a sell-off? We saw that with Samsung, by the way, as sort of a possibility of what could happen. Meanwhile, the earnings story looks great. So any sell-off on disappointments that earnings weren't even better than expected, I think we'll be bringing the dip buyers because the earnings story is still very strong. Forward earnings, S&P 500, 400, and 600, all at record highs. This is the forward profit margin of these sectors, and you can see forward profit margin, the S&P 500 has been soaring, but you've also seen some good solid increases in the mid caps, not yet at record highs, but maybe getting there. Meanwhile, the Magnificent Seven has had a nice rebound here. It's still lagging for the year 2.6 versus the X-Mags at 14.3. This is another way to look at breadth. S&P 100 divided by S&P 500. For all the talk about concentration, we did not so get as concentrated as we did back here during the tech bubble and tech wreck. And maybe if this is about as concentrated as it gets, then that kind of reduces the likelihood of some sort of wreck out there. Value is rising to a new high, so maybe growth kind of consolidates, particularly if our earnings are only as great as as was expected, and not better than great. So we may have some stalling out in growth, maybe some weakness in growth, but the value getting that being the beneficiary of that. The small caps, the Russell 1000 looks really good, so that's another sign of the broadening of the market. And then you can look at it on your own, but we're kind of trying to figure out the best way to keep on top of the sectors and industries, which ones are outperforming and which ones are not. And so you can look at these. This is sort of it's a work in progress, so you'll see more of that. Well, again, we're not going to have a Q and A because I had to pre-record it. I had another obligation for my Monday call. Hope you have a great week. It should be action-packed with Warsh and with the CPI and PPI and with the Strait of Hormuz. You got to say there's never a dull moment in our business. Sometimes it would be nice if there were, particularly in the summertime when we'd all like to get away to the beach and just read something that has nothing to do with our business. But war with us, we're going to have to stay informed, and I hope I can help you do that. Thanks very much. All the best.